Hello, everyone, and thank you so much for joining our webinar today. My name is Alexandra Alvarado, and I'm with the American Apartment Owners Association. I'm sure lots of you might recognize my face already by now, but today I am joined by three other new faces that we haven't had on our webinars before. Our panelists, Pam Goodwin, Ashley Wilson, and Kayle McMahon. We are going to be discussing today some high growth real estate strategies, getting to know these lovely ladies and how they got to where they are today. Just to let you know, before we start, we are going to be giving you all the recording. So you will be able to watch this tomorrow if you miss anything. And I'll also be sharing with you all of their contact information if you want to get in touch with any of these women here. And we will also be having some Q&A. So please, if you have questions, put it in the question box, and if I can, I will try to get to it. We have some questions prepared already, but we'll do the best we can to see what you all have in mind as well and use that for our discussion. So I'm going to start with a couple brief introductions. Thank you all for being here. Pam Goodwin here, well, she's on my left. I'm not sure about you, but Pam Goodwin is the founder and CEO of Goodwin Commercial based in Dallas, Texas, which is an award-winning boutique commercial real estate and consulting firm specializing in single tenant net lease properties. It's one of the reasons why I wanted you here, Pam, because you work in commercial, you have experience on the tenant commercial side, as well as the landlord side and buyer side as well. So I really want to pick your brain as to what commercial real estate is looking like nowadays. Now we also have Ashley Wilson with us, who's the co-founder of Bar Down Investments, LLC, the best-selling author of The Only Woman in the Room. That's actually how I found Ashley. She wrote a fantastic book where she interviewed women in real estate. She's also a Bigger Pockets series host with 13 years of real estate experience, involved in $100 million of transactions in both single and multifamily real estate, over 1,000 units. So lots of experience there to talk about. And Kayle, our apartment queen, she's the co-founder, she's actually the founder of the Apartment Queen. She's purchased over $68.2 million in multifamily real estate as a general partner and principal, sold over $3 million in residential real estate before transitioning into her current full-time syndication role. She founded the Women Who Invest Wednesday networking group and a podcast called Number One Leading Ladies. She's done home flipping, note buying, active and passive investing in apartments, and sometimes is even her own lender. And Kayle barely made it today from another meeting, so she has a lot on her plate too. Thank you all for coming and for spending the time with us. I want to get started with the first question, which is, how did you all get to where you are today? I'd love to learn just a brief synopsis of your story, and we could start with Pam, if that's okay.
Thank you so much for having me on. I'm thrilled to be here. But I started a long time ago, and I actually have a degree in interior design, thinking I wanted to do hotel design. I graduated from the University of Nebraska and almost took a position that I was offered with JW Marriott to design hotels, but I ended up staying in Omaha and designing office interiors for about 1 year before I got into large shopping center development. So within the last 30 years, have went from shopping centers, more on the project management, tenant coordination side, and then in Dallas here, worked on the tenant side for Brinker International. And at the time, they owned 7 restaurants. You may know 2 of them. They currently own Chili's and Maggiano's. And just I thought I actually went to go work for them because I thought I wanted to open up a restaurant, which seems crazy, and found out very quickly, working on the development side after developing more than 50 of those Chili's, it's best to be on the real estate side by owning and developing them versus operating a restaurant, similar to what McDonald's does. They're actually a real estate, multi-billion-dollar real estate company, just flipping burgers to pay their rent. And after doing that for more than 3 years at Brinker, decided, 16 years ago, to start my own business. And we specialize in developing single tenant net lease deals, the Walgreens, Chase, McDonald's type tenants. And we develop those, also do brokerage, more representing tenants, and then also do consulting and coaching, because I'm on a mission to make sure everyone knows how to buy commercial real estate.
I love that. That's why we have you here. Ashley, if you could also tell us a little bit about your background.
Yeah, so I went to school and wanted at Colgate University, and I wanted to be a neuropsychologist studying concussion syndromes in professional athletes. So I took some time off after I graduated from Colgate, and I worked in pharma. And while I was there, I was convinced to stay in pharma. So I worked in clinical R&D, which means that I worked on clinical trials prior to regulatory submission and approval. I worked in a global capacity. I worked for Sanofi Aventis, Wyeth, which is now Pfizer. And then lastly, GlaxoSmithKline. I worked in the vaccine development division, and I was working there as the director of global vaccine development when I left pharma. But while I was working in pharma, they call it the golden handcuff industry, because you are rewarded very lucratively for working in that industry, but it kind of keeps you in that industry and locks you in. So on the side, I started investing in real estate, and I've done everything kind of similar to Kayle. I've done everything from node investing to short-term rentals, long-term rentals, high-end flips, regular flips. Just I could go on and on about different industries or different asset classes I've worked in kind of passively and actively while having a W-2. And in 2014, I left the industry to transition and work full-time within real estate. I was fortunate enough to have a father who was a general contractor, and I firsthand witnessed both on the commercial and the residential side construction, coupled with the fact that my mother worked for a small business as a office manager for the entire company of about 30 employees. So it lent itself very well that I then positioned myself to work in construction and asset management of commercial properties, which is ultimately where I landed. And that's how I, opened the door to be able to partner with other people and work within the commercial space. So in short, what happened was I was asked if I could manage a couple $1 million renovation for a group that had no experience with construction management. Obviously, I had a background with the exposure of being raised in that environment, coupled with all of my managing from afar because of the fact that I worked as a global director. And then even when I started my flipping business, which I still have today of high-end flipping, I did that all while living in Europe and Russia. So I have always worked in a remote capacity, which lends itself very well to be in the commercial industry because you have to have systems in place in which you can operate from afar. And that's how I started about 4 years ago in multifamily. And I have since then built out my own company doing pretty much value add large commercial properties. We look for ideally 200 units or more. We syndicate and JV and use private equity and family office to acquire these properties. We look to reposition them within a very quick timeline, conservatively 3 to 5 years, but we can typically do it in a year to 2.5 years. Just because of my construction background, I know how to make systems work very efficiently in terms of repositioning. So that's what we do today. That's what we're looking to grow and expand within this space, and then also to within different asset classes. So right now, not only are we looking to purchase more existing apartments, but also we have started to look for development opportunities and also some other asset classes as well that we're going to add into the fold.
Great. Kayle, if you could tell us a little bit about your background. Oh, Kayle, I think you're muted still. Yeah.
So to answer the question, how where I am today, I'm going to reframe that question and turn it into who did it take to get where I am today? So we went over a little bit earlier, it's single family, multifamily, and then now fund managing. So still involved in the renovations, trying to change it a little bit, but it took for people to help me to learn what I did. And for me, I'm a hands-on learner. So whether it was the single family opportunity that I found that was a $20,000 crack house that basically we got in there and it was, again, an opportunity, someone else held the opportunity, gave it to me. They saw potential in me. I assume that's the case. Then when it came to getting into multifamily, it also took somebody else that saw what I was about as far as how I wanted to live my life and the type of people I wanted to be around. And so they were that kind of person, taught me all the underwriting, taught me all the renovation schedules. I didn't have a construction background. I also don't have a business background. So it's been an incredible learning curve for me. But luckily for me, I'm just built in as a natural lifelong learner. So I do really get joy from learning new things all the time. And it's constantly asking for help, asking questions, asking if I can take a peek, going to conferences, learning and reading everything that is ranked as a top selling book, like Ashley's book, for example, giving you a lens into what are you really getting into. But it's really about the people truly that have gotten me from single family into multifamily, and then learning even further how to now kind of go backwards a little bit and figure out how to create scale, build better processes. And it just takes people, really.
Great. Well, I love your backgrounds. I think they all are very interesting, especially Pam and Ashley and Kayle, how you all started thinking you were going to do something different, somehow landed in this and are doing just such a fantastic job. It's just amazing to me. I love those stories. You got lucky with meeting investors, Nina says. So yes, luck does happen, but you also have to be prepared when that luck comes around, right? So let's dive into a little bit more about the real estate market today. That is really why I wanted to pick your brain about the opportunities that we have in this market right now. What do you see as the overall outlook on either multifamily for Ashley and Kayle and Pam for commercial? What is coming down the road? Is the market going to be slowing down? Do you see it still maintaining the momentum that it has and that we've been seeing? Pam, if you want to start with that on the commercial side.
Being based here in Texas, it's still booming like crazy. And I think it will continue. As everyone knows and realizes, the biggest issue now is just labor and materials to try to build these. But, you know, they keep talking about interest rates going up higher to try to stabilize the economy. But driving around, there's still a lot of construction going on. I find it interesting. I read an article last week that here in Texas, they are going to be developing more one-story homes versus two-story homes just because they're not able to get the materials. So I think that has the biggest impact for us in Texas. I was just at our retail conference last week, and the buzz is that it's still booming. The restaurants are coming back. I'm representing a restaurant now, and that second gen space after the pandemic, when you drove around and saw so many vacant restaurants that did not reopen, now today in April, you can barely find one. As soon as they go on the market, they're being taken. So the restaurants are coming back. But, you know, until we get, you know, things back with the materials and everything else crazy world going on. I mean, but we're thankful we're here in Texas, and real estate's such a great opportunity.
That's fantastic. Ashley, you know, Pam just mentioned the supply chain issues. That's definitely a factor we're seeing as well, obviously in multifamily. You mentioned you are working on some new developments coming up. How is that affecting your outlook on the future of development?
Well, I think similar to what Pam said in the commercial space in general, we're seeing that in multifamily. I think the issue today is the presence of so much liquidity is the driving factor over fundamentals. And I think that what we're seeing today will continue for a bit. And then I think it will soften. I think right now the abundance of liquidity is driving the cap rate compression that we're seeing in multifamily. And even though, as Pam mentioned, the interest rate hikes, you know, the Fed has mentioned that they will be doing interest rate hikes at every single meeting the rest of this year. I don't have a crystal ball. Let's first start with that. But at the same time, I'm not a believer that they will hike the interest rate at every single meeting. I think that we'll probably get to about 2. And then I think we'll see softening, because just even the discussion around interest rate hikes that will soften the market itself. It almost has this same effect. So I think that has cooled some of the multifamily madness, as I like to call it. But at the same time, you have a couple things at play here. So you have a lot of people who have just transacted and now they need to find a home to place that capital. 1031 money is pushing the cap rate compression even further because, for example, just a few weeks ago, I met with a gentleman who was in a 1031 exchange and was willing to overpay a property by up to $2 million because his tax hit would have been $3 million. That in turn impacts the pricing on multifamily. So as long as that's still at play and we're seeing so many properties transact at such a higher rate than ever before. Q4, by the way, for multifamily was the second highest transaction rate across the entire country on record. Mm-hmm. So when you have that momentum where Q4 is normally kind of a more dormant quarter for multifamily transactions, and really Q1 of the following years when everyone launches in January, that too has, some driving force behind it. On the development side, to Pam's point, I think there are a lot of issues at play. The supply chain issues, I think we're still going to have an issue for the immediate future, but I think what's going to end up happening is we're going to have a role reversal. I think we're eventually going to have too much supply and not enough demand because there are so many different companies who are trying to come up with different strategies on how to curtail the supply chain issue. I think the real issue is our labor shortage. I think with trades, I think that is the problem that we are seeing today, that people are not going into trades as much as they used to. And I think it'll take a little bit of time for the pricing on the labor side, not necessarily the material side, to catch up. But once that does catch up, I think labor in the immediate future is going to be very expensive, and it'll drive people from, high school, college, even other professions to leave their profession and seek trades positions because it'll just be more lucrative, and it'll be more, work-life balance where they can set their own schedule and pick what jobs they want to do and what jobs they don't want to do.
Absolutely. And I think that's interesting you brought that up. Especially with the pandemic, people are seeing in the labor market the options that they have, and also what happens when those options are gone, and how does that affect where they're going to go into in the future. Definitely they're going to go where the money's at. And if that's where the money's going to be, we should probably expect those increased costs. I hadn't thought about it that way. Thank you. Kayle, for you, what is your outlook on multifamily, but also I know you work on a lot of different other kinds of real estate flips and so on. So any thoughts there?
Now it is just multifamily. So my outlook, I don't know how far in the future I'm allowed to kind of give an insight to, but I will say immediately, just because I've been watching the government's patterns with bond buying over the last 30, 40 years, because I haven't been in this business very long. So you have to look at historically what has happened. It's a cyclical situation in real estate always, especially, real estate. So by June 1, the government is supposed to be finished bond buying, or they're going to reduce their bond buying to zero. So typically when you're looking at trends, what you see over those past 30, 40 years is that when bond buying decreases, interest rates fluctuate up. So we've seen that happen after they started tapering down their bond buying in November 1 of last year. And so again, like I said, I believe the high of our interest rates will get fixed in June. I don't know the date, but in June. And so because of that, what happens is when the cost of money increases, we have to make an adjustment somewhere, right, in these transactions. So if the cost of supplies or doing a value add renovation, say for saying C-class properties, workforce housing, the cost of renovations or even buildings, so A and C, B's in the middle, I guess, is going up, interest rates are going up, the price has got to give, So in my head, it would make sense that probably starting sometime in June forward, that we're going to see some softening of pricing. One thing that I've seen for me to be able to get my hands on apartment deals is essentially been able to be as creative as possible, whether it's we're going to sell or carry this much. Okay, we're going to pay forward this. We're going to, as creative as you can get with however you're doing your financing. Again, like Ashley had mentioned about the 1031 exchanges, that's another huge thing that's motivating what's on the seller side. So again, with the one I'm negotiating right now, it's going to be like a $3 million tax hit, for them. And so we're trying to figure out a way to structure it to where that doesn't hurt them. And that's why they're picking us over some of the other offers that are available, because they don't know how to creatively structure things. Also, I don't know the answer to this, but I know that we have an election year for a presidential election coming up in 2024. So as far as the capital gains environment for a 1031, I have no idea where that's going to go. But as far as where it's at right now, I know it's not as tax friendly. And so those people in this situation in my head that I'm going through now, they're willing to structure this as a seller finance instead of doing a 1031, move that possible gain period or defer it forward, and then say, okay, well, let's look at this again when it's in more of a conducive environment for our 1031 capital gains to be maybe less than it is now. We just don't know what's going to happen. So, but that's 2024, a little bit of time. And then as far as, these changes happening with the expenses, what can we do to be able to counteract that or still be able to buy and move forward? Because I can't predict if it will for sure soften in June. I don't know, but as of today, it's not. And so if something happens where it continues to be as it is today, what can we do as an operations team to be able to be smarter about our expenses? And so I just was at a blockchain Bitcoin real estate conference yesterday in Miami. And yesterday we were learning a lot about smart contracts. So something a smart contract would be able to do, they're already out there. There's a mortgage company that's using them. There's several titles and lenders. So basically that would decrease your closing costs and decrease a lot of these intermediaries and be able to make it 100% secure, where it's going peer-to-peer, lender to anyone in the transaction. It'd be 100% secure and be able to reduce the amount of time that it takes to close on the property and then reduce the cost. So it's good for the seller and the buyer in both those situations. So that helps to make you more competitive and then be able to, because these closing costs are huge, when you look at what it is overall totals, we have to raise an additional amount for that. So what can we do to be able to be a little more strategic to deal with what is in the present instead of living in the future? So I'm working on that personally and professionally, but I think that I don't know the answer, but these are things that I see coming. And then as far as having smart contracts being accepted into the industry, I believe that within 2 years, we're going to be seeing that as a total norm, because people are going to need to pivot in some other way in their business.
That's interesting. So you guys mentioned 1031 exchanges. I know we've all been waiting for when or we're going to see any changes on that, if we'll see any changes on that. And certainly it has to do a lot with the administration. There have been lots of threats by the Biden administration that they may go away, which, as Ashley was mentioning, really drives the real estate market. And so hopefully, fingers crossed, we'll have that opportunity to keep doing those 1031 exchanges. One issue that a lot of 1031 exchange investors have is finding that replacement property with an inventory that is so tight right now. Have you been seeing that on your end? What does an investor need to do to find opportunities in this market and really be able to get that next property that they want? And I'd love to hear from you, Ashley, on what you're seeing on that end, and then Pam on the commercial side.
I think Kayle actually kind of did a prelude to it of what you have to do, which is get creative and creative structure, not only creatively, structure the deals, but also creatively source the deals. So in terms of just, if you're waiting for a deal to come to you from a broker, that's, you can wait for the rest of your life. It's probably never coming. You're going to be outside that 1031 window. But if you are very proactive, brokers love 1031s because just keep in mind that brokers are also, unlike residential brokers, commercial brokers are more engaged in the sale because of the long closing time is directly tied with their ability to continue to list the property if the deal falls out of contract. In other words, if a deal falls out of contract on the commercial side, a lot of sellers often will switch brokerages, where on the residential side, you don't see that happen as much. So they're more engaged, they're more helpful in vetting the buyer's ability to close. So a 1031 is security of closing. Really, it's language for the broker that speaks to their ears. It's like, this is a good buyer, because they have to transact. So I just think in terms of, how you source a deal, you can obviously do the guerrilla type marketing, going direct to seller, but also too getting creative on all of the different actors in the commercial space. So I'm talking about your construction company, your lender, maybe your title agency. There are so many different moving parts in this industry, and everyone's talking and everyone knows of a deal that you could potentially get. So just seeing the broker as the only source for finding properties, I think is kind of too narrow-minded, and especially in this competitive environment. One thing we didn't talk about on the last question, but I just want to kind of highlight this as well, is that there's a lot of foreign capital coming into the US market. And I'm married to Canadian, so I get a lot of exposure to the Canadian market, the investing market, and they have a deterrence of foreign capital being invested into their market through foreign investor tax, which we don't have in the US. So in terms of foreign investors coming into the US, not only were they historically coming in, but now more than ever, because of our inflationary environment, it makes it more lucrative for them to come in because their dollar goes further. So in terms of that being a factor too, that creates additional competition, and they're very proactive in trying to find different properties and resources, and also get creative too on the actual property itself. So, we're talking a lot about large multifamily properties and large commercial properties on this call. And there's still opportunity to do it in the large space, but most people think of it more on the, residential multifamily or maybe small commercial multifamily, which is looking for ways to maximize the zoning allowance for number of units. So maybe build double decking, to Pam's point, there's all these single family or single story residential houses. Well, what if you find a single story multifamily complex that you can raise the roof and double deck and find value that way? Or maybe you can add storage on, or maybe you can lease adjacent land that's part of the same parcel to a farmer and make on that land rental. Coming up with creative ways to maximize the value of the asset will also help you secure that investment opportunity.
I love the value add that you mentioned. We'll maybe come back to that. Pam, on the commercial side, are you seeing that same sort of dilemma as far as inventory? Or I know you're based out of Texas. It sounds like it's a strong market there. What are you seeing?
Same thing that Ashley and Kayle touched on. Sellers are, having a difficult time finding that replacement property. But my motto is everything is for sale, and you really have to be creative. I recently worked with a 1031 exchange buyer, and I actually sold a McDonald's that my client had. And it's just on the relationships that we have, with each other, to be able to reach out to them to see if they have anything for sale. I still think with the social media, if I'm ever looking for a client for a property to acquire, if I post it on LinkedIn, one great resource, or any of the social media, you can get a response. But it's it's all the creative things you talk about. One place that I always go visit is the local economic development director. They have a contact in their city with every single property owner, and they know exactly who is selling. So that's a great resource, just to look on the website or the EDC director and go meet with them or go call them, or they actually, so many of them list their available properties for sale, either city-owned property, or, if a property owner is selling, they will list it, on their website right there. But you have to be creative, because talking about capital gains, I heard it actually may be going up, and it's pretty high right now. I've had to pay it myself, and I don't, so it's going to be an issue on people selling. But I've been in this business for more than 30 years, and everybody all day long, just like Monopoly around the world, they're continuing to buy, sell, no matter what happens in the economy. All day long, people are buying and selling real estate.
Well, that's a good outlook over the course of a long-term prediction there. So I want to go back a little bit to value add, which you've all touched on a little bit. And really, I'd love to get an example of a success story that you all have had with one of your clients, or personally yourself, in doing a value add sort of renovation or project, and what that looked like. And maybe through that, we can give some insight to our members that are on the call as to how they could maybe do something similar. Kayle, if you want to take that one away.
Yeah, I think the biggest success overall has just been when we get into a property and we're able to be creative. That's really it. So for example, coming in and saying, okay, we have a plat of land on the back, let's do some storage. We already can for example, be creative with the types of supplies that we are going to use up front. So that's what I budgeted for. And so instead, like, for example, I'm looking into building things, what is an alternative building strategy? Am I going to go with a boxable type setup where it's essentially a 50 grand, a door, 1 hour to set up, stack those and put it into a garden style complex, anything like that, which would already go into it with a certain budget, to be creative. So adding storage, reusing space, for like an arcade, vending machines, any ways to add, laundry, soap on the wall. I mean, anything that you can go in there and just keep, I travel a lot. So I go into places and I go, oh, picture, great idea. Oh, parcel service, great idea. Certain things, and then asking other owner operators, what are they doing? So one property that was a little bit of vending in the laundry room, buying our own laundry machine. So instead of having that outsourced to CSC or a contract service, we owned all the income that came in through those. And then what else? Creating some storage lockers, paid parking, bought the property for $1 million, sold it for 1.8 in 13 months. So that's a short example.
That's great. Wonderful. Ashley, do you have a success story similar so you can share?
Yeah, we've had a few great successes in multifamily. So I'll give a few specific examples and then I'll speak on more of a macro level. So in terms of assessing value in multifamily, the value is assessed 3 different ways, but the most common way in terms of transacting is through the NOI approach, which is looking at your income minus your expenses divided by the trading cap rate in the market. So in terms of how do you find value in a value add, you obviously can increase the income, decrease the expenses, or a combination of the two. So when we go into a property, most people think, okay, how do we just push that income, push it on the rents by taking care of deferred maintenance, and then also through other forced appreciation ways of improving to Kayle's point, whether it's amenities that are provided or just a better living environment altogether. But then there is also things on the expense side you can do, which is decrease your expenses. I'm a huge believer in renegotiating contracts with expenses. So I renegotiate every single contract, even if it's an existing contract that I've inherited. I will go back and re-exist and reset terms, because a lot of different companies will be willing to do that because it resets how long they have left on their term, and it eliminates the risk exposure of not having that client on their balance sheet, right? So that's one example. Another example, just from a very specific perspective, is kind of deep diving on those expenses. So for example, we had a property that had all of these gardens throughout the property. And when we took over the property, there was about a $3,500 repair cost to fix the irrigation system. And then from there is the quarterly landscape tune up, there's the monthly landscape, there's the water bill, the utilities, etc. When you add up all of those things, it hits the NOI pretty hard, right? Because it's an expense burden. So what we decided to do is we actually invested in removing all of those gardens, and that came at a pretty hefty price. It was about $75,000 to remove all of those gardens. But what did that do to the NOI? Well, the NOI at the current cap rate that was at that time, not our exit cap rate, but the current cap rate, when we did the analysis, it was over $360,000 of value created. So, and then we didn't have the continued expense burden every single month, every single quarter. So when you look at trying to push NOI, don't only think of it in terms of the renovation on the income side. The other thing too, I think that a lot of people get wrong is a lot of people think that the name of the game is to just increase the NOI, but I look at it quite differently. I look at it as increase your equity. how do you increase your equity on the property? By doing what I just did, I increased my equity on the property. My investment was $75,000. I got out $360 on the backside, right? So in terms of increasing my equity, I did it there. But let's say, for example, the renovation was $400,000. Would it be worth it then? Well, some people could argue yes, because you still don't have that continued expense burden every single year. So maybe it would be worth it to them. For us, it probably wouldn't be worth it. But there is always kind of a internal barometer for every single ownership group as to when to make the renovation and when not to make the renovation. So that is something, we've had success on. The other thing I would say that we had success on is I am a very detail-oriented person when it comes to operations. I am known for operations in this industry, and it's because I have OCD and I'm a bit crazy, and I'm fine with it. People know that about me. I know that about me. I'm good with it. But one thing that we found success in is a lot of people, when COVID first started, they were all complaining about primary markets not having the same collection rate as secondary and tertiary markets, that everyone was moving out to these secondary and tertiary markets, and it was having a huge hit on these primary markets. Across my entire portfolio, I didn't see a variance at all. And I spoke to a lot of different people, and I'm sure there are other people who had the same success, but because I think it was in part because of my vaccine background before coming into the industry. I mean, who would have known that I previously worked on a pandemic before? I worked on H1N1 vaccine. So I knew I worked with the World Health Organization. I knew what was coming down the pike. So I'd already put a lot of steps in place in February and end of February, beginning of March, when this was starting to be a buzz, because I knew it was bigger than, what was kind of being circulated, and I knew the fallout of it. So because of all of those things, we were able to put measurements in place, and we had over 100% collection month over month across our entire portfolio. And how do you get over 100%? Because some people might be saying that's impossible, because people prepaid their rent. So we did it in such a way, and we had weekly check-ins, not only to assess whether or not someone was furloughed off of their job, but also to see what companies were still keeping their employees at work. And then we actually marketed to those companies to get their employees to stay with us. So it was kind of a very proactive way in which we were measuring. We also, too, as soon as we knew that they were let go of their job, we helped them apply for assistance. So there wasn't a gap. We literally handheld, all of our residents' hands who needed it and wanted it to walk through the process. So they still stayed in the routine, because there's always a psychology behind everything, that there's a routine in paying your rent. They never got out of that cycle of paying their rent. So we've had a lot of different successes. I think it's in large part due to, we have a tremendous team, from the property management to our partners, our investors. Our investors have a lot of trust in us, and we protect their money. So I'm glad it's reciprocated, but I'm glad to say, we've had a few successes over the years here.
Wow, what a unique insight that you had just had. I mean, from all your background experience, nobody else could have seen it coming. You were already so prepared for it. That's amazing. I love the steps that you took and what you said about keeping people on track and in that habit. It is so important. And so really glad to see that worked out, and good way to think about it, really. Pam, if you could tell us a little bit about, on the commercial side, some of the success stories you've seen more recently.
So we typically either develop from the ground up, or nowadays more take an existing building to redevelop. So I learned from the Brinker days, going to the smaller communities, as you talked about, there's a lot of advantages of going out there. And we just took, for example, a small building, maybe about 3,000 square feet, and thought the seller had a pretty high price on it. And a lot of people had turned it down because you had to really equate about $30 in rent. And even when I put it under contract, everybody was like, there's no way you'll ever get $30 in rent. And in the past, I probably would have followed everybody else and listened and said, okay, that's okay. You're right. It's probably too expensive, and pass on it like I have. But I just knew it was such a great hard corner, but it looked like a piece of junk building. And anything looks good with new paint on it on the outside. And we ended up getting Mattress Firm. And I was so excited to tell everybody, you were right. I did not get $30 in rent. I ended up getting $33 a square foot in rent. So, there's a lot of opportunities out there that could, stand a new coat of paint and can really increase the value. We just put about $150,000 into the building for that particular tenant and then sold it at a very good cap rate. So, but, there's a lot of opportunities out there. A lot of people are, could be listening today wanting to get into single tenant net lease properties, and just wanted to share for pretty much about the first 10 years, I learned to collaborate with other partners that brought in the financial part. And so if you're out there, I can guarantee if you just drive around your community, you will find some type of property to buy. And I always, I know Kaylee and we used to do a talk show together at the same studio. And one thing that I always shared, everybody's like, how do I become a real estate investor? And I always tell them, go to Vistaprint, go make some business cards for $10 and call yourself a real estate investor. And anytime you're at a restaurant, I went to my dry cleaners, ended up getting a deal there, ask and say, hey, would you ever like to sell your building? I'm a real estate investor, and just start passing your card out. And then, if they call you back or they're like, yes, I'd like to sell, find someone and collaborate with someone that has experience. And that's how I learned, just teaming up with people. I mean, I've been doing it for a long time now, but I've really learned in this business, you need to build relationship, go to events, and team up with a partner. You can call me, call Ashley, call Kaylee. We're always looking for deals.
Yeah, that was actually my next question, because I know I've seen a couple comments in the chat and questions, and just in general, you're right. We get that question all the time, is how do I break in? Maybe I just have, several single family homes, but I want to go into commercial multifamily or commercial retail space or something like that, which is different and can be very scary for an investor that hasn't gone there before. So Pam, it seems like you answered that. And also another question that came in as well was really just about getting into syndication as well, how to build trust there for if you don't have a track record, and how do you form a syndicate, that kind of thing. So Ashley and Kaylee, we can start with Ashley. If you could give us a little insight as to what advice you would give to someone trying to break into or step up their investments.
So I think Pam hit the nail on the head. I mean, that's the answer that I give, but I'm just going to take one step further on something that I say is I get bombarded through social media, through events, asking me constantly, how do I break in? I don't know how to do it. Where do I start? And what I always say is, you're wasting your time talking to me right now. And they're like, what do you mean? And I'm like, because you don't lead with value. You're not leading with value. The best thing about the commercial industry is every single industry. I mean, you said it at the very beginning. None of us started in commercial. None of us did. We didn't grow up in commercial. We didn't start in commercial. It wasn't like you had to have the pedigree to be in commercial. We all started with something else and we transitioned to commercial. The reason that is because everything else that you do prior to getting into commercial real estate is transferable. Every single thing, whether you're in marketing, whether you're in tax, you're doing accounting and taxes, whether you're a lawyer, whether you're a project manager. I mean, literally every single business can transition into commercial real estate. So when you have an opportunity to talk to Pam or Kaylee or me or anyone else, what you should be saying is, this is what I'm really good at. This is how I could help your business. Is there any way that I can work with you and put in sweat equity, as Pam mentioned, that she's done in the past, and I've done in the past, I'm sure Kaylee's done in the past. Is there any way that I can trade my sweat equity for being mentored by you, or, or working with you or partnering with you? And that's how you get your foot in the door. the way I was able to get my foot in the door is because I said, I really want to get into commercial industry. And I think the way I can do it is because I have a really strong construction background. And the person I was talking to just happened to be under contract for 124 units, which they were going to do a little bit of CapEx. But while they were under contract, a whole building burnt to the ground and they had no construction background experience and they needed someone to lead the project. So it was just because I said what I was good at, what I could bring to the table. And that's how that opportunity opened up. So I think first and foremost is always, always, always lead with value. Do not lead with your deficit, lead with value. And the next thing is, I think there's too many people who don't get started because they think that the financial requirement is needed from them. And that couldn't be further from the truth. When I first got started in real estate, I used my own capital and it was to my detriment. It's probably the biggest mistake that I've made in the entire career in real estate, because once I got to my limit of how much money I had to invest, that's when my growth stopped, because I had never paid attention to how to raise capital or how to partner with people who can raise capital. I had never focused on that. And that is something that has been more of a, an afterthought for me throughout my entire career in real estate. So it was really paramount for me to partner with people who are great at social media, who are great at marketing, who are great at talking to investors and facilitating that conversation, because I was so focused on the asset itself. I was so focused on the real estate component of it. And I still am today. I think that's why people invest with us. But I also think it's because my partner is incredible with talking to investors. He's very transparent. He's very communicative. And that's something that he is exceptional at, but he allows me to be exceptional at managing the asset. And that's why we're a good partnership. And he didn't have, large multifamily experience beforehand. He had a tremendous amount of real estate experience before, but he wasn't in large multifamily before. And it was a natural partnership because he led with value. So that's what I would say is the number one thing. If you take anything away from this call, and it's not just because I'm saying it, it's just because when I talk to successful people, the one thing we all have in common is we didn't start in commercial real estate, but we led in value. And that's how we got to where we are today.
I love that message. I think it's so important for people on this call to hear, especially because we did get that question so much. And then I kind of want to change a little course here because I got a great question from Joseph talking about build to rent subdivisions being seen as a threat in some municipalities, hearing about local legislation that could restrict traditional multifamily development in the future. Is that something that you have been looking at or that you consider getting into local sort of government affairs as part of your investment strategy? Any one of you, if you have a comment on that, can take that one away.
I can talk about it because I have direct experience with it if you want.
Sure.
One of our properties, the only property we competed against was a community that was built to rent. And this was about 3 years ago that I know build to rent is the rage now, but build to rent's been going on for a while. It's just more attention is on the BTR model today than ever before. We had to watch very closely how they were pricing their detached homes, because we were competing similar product, right? The one advantage we had is we had a tremendous amount of amenity spaces. So what we sold is not only the amenities, but the community that we were creating. So all of our properties, we have a community calendar, and every single month we have a community event that is a community event for our residents, but then we throw in community events on top of that for the greater community, the community at large. So what we tried to push, and I think we were successful at doing it, is that, you have these amenities built in coupled with this community environment, security, blah, 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 that, it lends itself well, if you want these extra perks to be in this community. I do think that there are a lot of people today who are performing out apartments and they are not considering competing BTRs that are being developed in the area. I also think too, with the BTR model, I think in the short term, I think it's very competitive because of the development side of things. But I wonder long-term how it's going to hold up, because operationally it is such a higher expense. When you can put 20 units under a single roof versus 20 different separate roofs, unless you can, individually parcel each unit and then sell them off down the road, I see that long-term operationally, I think it's going to have a high cost burden on the expense side. And I wonder how that is going to be able to be sustainable. But right now, as the communities are being built, I think there's just a lot of buzz, and it's also to a huge fad. I think a better model personally is more like I call it LTO. I don't know if anyone else does, but it's lease to own. So you act as the bank, as Kaylee was talking about before, of holding back the note. If you develop the property, hold the note, and then do a lease to own model, you can obviously, if someone doesn't pay their rent, you can foreclose on them and take back the property. But alternatively, you always want to create opportunities in which you're the debt, like someone's paying you debt. It's very advantageous. So those are my thoughts on the BTR model and how it's impacting multifamily.
Yeah, I've been hearing a lot about it. So thank you for clearing that up. Definitely a consideration of, gosh, yeah, you're right. The operating costs would be kind of hefty on that over time. So
it sounds like sticking to principles is working, you know what I mean? Not getting distracted. So like Ashley said about one or two roofs, one plumbing system, one office. What like economies of scale is what operationally is going to make it work. So when I look at single family home packages, I'm kind of like, for exactly those reasons. And then to add on, not just the rent to own model, or I think there's a different way to say it. I think you said it right,
Kayle,
Ashley.
I think we lost your sound, actually.
Can you hear me? Testing. Nope. Are you there?
I can hear you.
Okay. So basically, their alternative to it, there's a legal way to say it, not lease to own or rent to own, but there's a contract name for it here in Texas. But essentially, also the McDonald's model. If we have the underlying property that still have depreciation on that, and there's like no maintenance on that, like a mobile home park, I think that's another great alternative to single, if you happen to have properties that were built for rent to own.
Great. Sorry, I think I lost sound for just a couple minutes there, but I heard mobile home, alternate investments. Let's kind of talk a little bit about that and what sort of investments or asset classes you're seeing as having the most opportunity right now. If you could, any of you, take that question away.
I personally think it's still multifamily is the, in terms of why I got into multifamily in the first place, there are a lot of reasons, but one reason was it was a hedge against inflation. Typically rents trend with inflation. So as we continue to be in an inflationary environment, most likely we'll continue to see the rents also increase at a similar trend. I also think too, in terms of just the ability to control the evaluation is still it's very advantageous for an investor. So what I was talking about earlier about one of the 3 ways to evaluate multifamily, the NOI approach, which is still used today to assess value of apartments, I think that control still will continue to attract people to the multifamily space. Also, too, when you just look at the numbers, there's still a housing shortage. We do not have an end date as to when the supply with the demand is going to catch up. So to that effect, I think we're still going to see it. Obviously, I'm not saying that every single market in the entire country is in this situation, but major MSAs are. And that's really where we're getting a lot of our data from, because that's where we're investing in.
Great. And also, I'm seeing some comments here really geared towards beginner investors. And I know we touched on some tips there for finding the right partner and being creative and getting into it and just getting your feet wet. Someone here asking what would be the best type of property to get into if you are in that position. You mentioned multifamily is obviously like a great asset class to be involved with, but is it advisable to get into that straight away? Should you start with condos or single family or mobile home first? What do you advise there for someone like that? Kaylee, if you want to answer that question.
Sure. I think it kind of loops back into the same question we were asking before is, your team, how do we get into multifamily providing some kind of value? So what part of the team would you essentially be a part of? So whether it's bringing a deal or whether it's, what was the question one more time?
Just for beginner investors, what would be the best type of type of property to get into to start, and how? Multifamily right away, would it be, or small multifamily, I would say, for a beginner versus a single family or a condo or a townhome? What would be the process there, and what should they choose?
I would say it's just all about the team. Literally, if you have a large property, whether it's a large set of commercial, whatever it is, a large set of something, that's where your risk reduces because you have it's your team. And if you're in a lot of units, the risk of a vacancy issue goes down. When you're in a lot of units, you have economies of scale. So you have less expensive supplies. So the bigger the property is, the better I believe that it is for risk factors and for screwing up. But you can't get into those without the right team, and the right team will not be able to get into those without having a track record, without being able to sign on the loan because they've done it before, without having operations and systems. You're not going to see a new bunch of people get into a 250, 60 unit property tomorrow. You have to have that team. And so essentially, I think that being able to be a part of a team like that and see how they do it well, if I could go back and get into this industry again, instead of trying to do it all myself, instead of putting all my capital into a small 24 and then 50 unit property, what I would have done instead was just say, let's go up to the 200 unit property, see how this team does it, and learn it the right way up front. And then be able to take a step back in your ego and say, what can I provide to that team to be able to make this a collaborative effort for success?
I like that. So don't be afraid to start big. As long as you have the right team, you will get what you need out of it. No need to do it all yourself. So that's definitely an important tip, I think, for all those starting out that want to grow their portfolio. Maybe they've only owned single family in their own name before. So that's a great tip. Thank you. Another thing that's been coming up and something that we could end with as our last question is, what do you see really happening in the real estate market on a state by state level or city level? Where do you see the most opportunity right now, or markets that may be overpriced likewise? So or either overpriced markets or really great markets that you could get into today. If you want to take that away, Ashley, what have you been seeing on your end?
Yeah, can I just add just one little thing to what
Absolutely,
Kayle mentioned?
Please.
And then I'll answer that question. I just want to say that you don't always have to be in commercial real estate in an active capacity. So you can either be an active or a passive investor. So passive investors, there's a lot of different opportunities out there where you can passively invest. Maybe you are a physician, maybe you're an engineer, maybe you have some niche job that you do not want to leave. You're happy, you're content with what you're doing, and you don't want to take on an active role. You can passively invest. There are a lot of different investment opportunities out there. Likewise, if you want to go into a more active role, to Kaylee's point, the team absolutely does matter. So there's really two methods there in active investing. One is either you go big or go home. To Kaylee's point, you have a team, you partner with a well-established team, and that's how you can take on bigger deals sooner. Alternatively, you can do what's called the stacking method, which is more so like doing, a duplex, then a quad, then an 8-plex, then a 16 unit, and you kind of I mean, it doesn't have to be exactly that, but something to the effect of where maybe you house hack first, and maybe you do short-term rentals, and maybe you do a single rental and then a 20 unit, you just build on your own experience. So there's a lot of different ways you can get involved. I just don't want anyone listening to think the only way you can get involved is if you're actively buying apartments, because the majority of people don't. The majority of people rely on people like us that are on this call to help them invest, whether it's with their self-directed IRAs, whether it's with traditional cash, however, with a trust. There are a lot of different investment vehicles. So I just wanted to say that. In terms of different investment opportunities that I'm seeing today, in terms of, strong markets versus markets that I think are overpriced, I am going to go out on a limb, and I still think that there is going to be continual push within this market, but I think that there will be softening as well, which is I cannot get over the pricing in the Boise market. I absolutely cannot justify in my mind how raw land is trading higher in Boise, Idaho than Austin, Texas. That does not make fundamental sense to me. And I am not just talking about just because it's Boise versus Austin. I'm talking about the economic diversity between those two markets are night and day. And I look for very economically diverse markets. So to substantiate the fact that Boise's market is so, it's literally exploding. And I think it's in part because you have all of these people from California that are moving to Boise. That's a huge part of it. And there's a shortage in supply, in part because there was a building moratorium. And to that point, I think that when you have a lot of people from California who are used to paying high price for real estate transition to what they feel is very affordable, it is very affordable from what they were paying before. I think when they go through a couple winters, they might be flocking back to California, because people typically, if they're, flocking to the Sun Belt, they're going down south. As U-Haul reports tell us every single year, everyone's moving south. I just don't see that being sustainable. So that is a market where, it is gangbusters. It's the number one market in terms of inflation, number one market in terms of rental growth, number one forecasted market on all of these different reports. I just do not believe that it's a good long-term investment at that rate. People may hate me for that, so I'm sorry, but I just have to say it. In terms of strong markets, obviously, we still continue to see Texas just crush it between DFW, Austin, San Antonio, Houston. And what I think you're going to see now is more secondary markets that are in transition, logistically, on the way to like Houston to Dallas, or Houston to Austin, or Houston to San Antonio, or San Antonio to Austin, all of those markets in between. I think because of the growth and development of those cities, it continues to press outwards. And I think secondary markets are going to be a huge play in the Texas area, Phoenix, Orlando, all Carolinas. I think we're going to see continue movement there. Also to that point, and I say this, and I don't know anyone else who's talking about this, and I could be wrong on this, but I am a firm believer that these markets have been really strong for two reasons. One is because obviously the weather, but two is also because of the ability to do business, because they are landlord-friendly states. I think in our immediate future, we are going to see states turn from being red states to blue states because of the people that are moving into these states. And I think it's going to change the governing laws. And I think that it would not surprise me that within 10 years or less, if Texas became more of a tenant-friendly state as opposed to a landlord-friendly state. I do not know what's the outcome, the fallout of that's going to be. I don't know if that's going to push investors out or not, or if it's just going to change their business strategy. But I do believe that we are going to see changes in tenant versus landlord-friendly states in the immediate future, just due to migration patterns alone.
Really interesting take on that. I absolutely agree about overpriced markets in Boise, Idaho. I see those reports too, and I'm like, what? How? So I definitely see what you're saying. A couple people I heard too that were on the chat were saying, well, what about California? So that goes back to what you were saying about having, you know, a less tenant-friendly state in California. A lot of California investors are thinking about, you know, exiting. There are a couple new things in California that might make it a little more landlord friendly, like building ADUs within the units that they have is becoming a little easier. But I mean, for the most part, I think you're right in that Texas is really taking the lead here on good places to invest, at least for now, until anything else changes. All things remaining the same, it's a good market. Kayle, any thoughts there on a market that you're looking at?
No, but yes. So the way that I have structured my fund is that we can only invest in Texas, and that just is what it is. So we have to focus on where is the opportunity in Texas and how can we stay diversified. So for example, we've purchased a property where the tenant income is 4.5 times what our rents are in Corpus Christi. So there's a whole lot of variables that come with that: wind, hail, storms, insurance costs. I mean, there's that. And then looking again in secondary or tertiary market possibility, especially when there is distress, it's just making that fit. And then we're getting into a time frame here where I'm going to have to find another creative method to do this because debt funds, bridge lending, we've got to stop that. We got to literally just go all the way to fixed long-term debt. So these unstable properties that I've been going after in Texas, I've got to be able to execute a business plan and get out of them pretty quick. And now with things changing, that may not be the case. And so because of that, looking at other areas that have interesting factors coming into play. So while I've been in Florida, I've learned a lot about the way that their mayor now is bringing more education. It's now mandated in high schools. And so I believe in the future that people are going to be more educated and be able to invest in the community here in Florida. And then also there's a big tech center it's been very collaborative and tech friendly in Miami, for example. And so there are a lot of people from foreign countries and from the United States moving to Miami. I think that's only going to get a little crazier over the next 24 months, to tell you the truth, as it becomes more friendly. And then there's markets that are kind of sub-markets that are being overlooked, I believe, here in Florida. So Pensacola is one that I'm excited about, but again, my fund can't invest here. So there may be an alternative method where I partner with a family office I've met here that they have boots on the ground, they have everything they need, and be able to also in Pensacola, because it's a military town, you got to operationally be able to be ready for that, the mass turns and being able to operate that type of property. So it's not for everybody, but it is a possible opportunity. And Davie, Florida is another kind of like small pocket that I think is another overlooked area. Get some kind of good price, but I do believe that Florida is going to be doing a lot of great things for sure in the next 5 years. And then in Texas, again, just kind of focusing on those secondary markets and leaning on relationships with other people. And like the property that's behind me right now that we're working on, I know the seller. So it's all about relationships. And so if you want to figure out where's the good market, I would say those areas in Florida, and then just areas in Texas that are secondary that have infrastructure for hospitals, for airports, for shopping, for everything that you need for people to stay there, plus job growth. I would go for those. And then those are the two things that I focus on. We do have one deal in Phoenix. I'm really sad that we're going to exit that deal. I would rather just refinance out because like our delta from what we bought it for is like almost $200,000, almost like 180 or something, insane. So we should just refi. So I will no longer be there, and I don't study enough of Phoenix, but I would say secondary markets, Texas, and those areas of Florida.
Great. And Pam, I know you are based in Texas, so you have the most knowledge about Texas. So if you want to talk about Texas and Dallas-Fort Worth area, why that is a good area, and also as well, why commercial may have some advantages in that area versus residential.
So everything Ashley and Kayle said regarding Texas and the small markets are really booming out here, because I've recently seen a couple big cities here location that they have completely stopped multifamily. And being in the retail world, we really follow the housing and multifamily. I wanted to get back at, a lot of people I think are surprised with commercial real estate, going back to the question of how to get into it. I think people would find out that you can actually buy a really good building for about $300,000. There's a lot of condos going up. That's a great way to get in. and a lot of medical use are going in those buildings. My husband and I, we bought a small little office building, about 1,700 square feet, had one tenant in it. And then with the cap rate, we, a little bit, we were able to sell it for about 400,000 in a small time. And that took 20% down, 60,000. So if you don't have the $60,000, you can always ask friends and family, post it on LinkedIn that you're looking, for $60,000, but that's just one small deal to get in. One other way we really find some good properties I wanted to mention is an app, and I have no affiliation with them, but this is an app that I use all the time. It's Land Glide. So I'm not sure if you all use that, but it's a great way to find out who is actually paying the taxes on that property. And most of the time it is the owner. So if you're driving around and you happen to see land or a duplex or a property, just look it up on Land Glide and it will give you a good resource on how to find that owner and start reaching out to them. But we're really focused on redevelopment of properties and hitting those smaller markets that are just, really, really growing. There's one right by me, about 30 minutes north, that used to be a no man's land, and everything's going out there. So just take a weekend, a Saturday or Sunday, and go drive the area and then go meet with that local economic development director and pick up one of their large aerial maps that they will give you. And if you stay with it, there's lots of opportunities out there all day long.
Wonderful. Well, we'll end it on that note. There are lots of opportunities. So thank you all for being on the call with us. I know I saw a bunch of people put in questions in chat. I'm so sorry if we didn't get to it, but all of your questions will be answered offline if we didn't get to them here. I always do that. And I'll also be sending you tomorrow the recording with all of the information of our wonderful panelists today, so you can connect with them. They do have great opportunities that you can get involved with if you are looking to do something like that, or if you need help with anything. It seems like at least Pam, Ashley, and Kayle, you are generous with your time. So I am happy to refer our members to you for those types of questions, if that's okay. With that being said, thank you. Thank you so much for your time and for all of your insight. It was really informative. I'm seeing lots of thank yous in the chat as well. So, all right, everyone. Have a wonderful day. Bye. Take care.
Y'all.
See ya.